Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide for chapter 12, the group B problems. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And so problem 42, let me get my pen. And so financial statement analysis ratio. You have been hired as an investment analyst at Walker Securities. It is your job to recommend investments for your client. You have the following information for two different companies, Anderson Supply and Mutual Materials, and these are the ratios. So one, write a memo to your client recommending the company you believe to be a more attractive investment. Explain the reasons for your recommendation. So here's the ratios for the two companies, and basically it's those ratios were doing what we had done for problem 12-41, right? I'm going to erase some of this. And what you had here was you had income statement information, you have balance sheet information, you have beginning of year, ending of year, okay? And so the theory being is that from chapter 1 in the textbook, you started out with the basic understanding fundamentals of accounting, what's a debit, credit, that type of stuff. And by the end of chapter 3, you had done the books for companies. You had journalized transactions, you posted them to the ledger accounts, you went through the worksheet, you were able to create the financial statements, which is the information you're looking at, right? That was chapters 1, 2, and 3. Now you're taking that information. Now realize that chapters 4 through 11, okay, all talked about the various aspects of these financial statements and why figures are what they are, okay? Like for example, I just quickly glanced here and saw accounts receivable net, okay? Well, just because you have accounts receivable on your ledger account doesn't mean that's the right amount. I mean, you have to take into consideration bad debt, things like this. Same with prepaid expenses. Just because you prepay an expense doesn't mean that that account is right. So through chapters 4 through 11 went through the various aspects of all of the accounts on the financial statements in order to be able to make sure that the numbers that you are looking at are accurate. Okay, so now you have these accurate numbers, right? And you're going to then create your ratios, answering the 5 key questions or whatever purpose that you're using for this analysis. In this case here, it's comparing one company to the next. So you come up with these ratios, and then you make your financial decision based upon what it is. You answer whatever questions you have from an analysis perspective. So in problem 42 here, you're already being given this information. We didn't have to go back and calculate it like we did in problem 12-41, right? But now that we have this information, it's saying, you're working for an investment company and create a memo. Well, I'm not going to rewrite a memo, okay? You can look at that memo in your solution manual, and you can read through it, okay? Let's see here. And I'm going to read the memo, so go ahead and look at the memo in your solution manual, and we'll just briefly talk about this. But this is the crux of, financial analysis. I mean, doing things like this, or trying to decide which company is a better investment, or even, whether your company is improving or declining, which would have been something like, problem 40, right? So what I'm getting at here is pay very close attention to problem 40, 41, and 42 because they are the reasons why you're doing all of this work. Okay, and it's the very last thing in the textbook, and everything that came before is a culmination of what you're looking at right now. Okay, when you're doing problems 40, 41, and 42. Right? If you don't understand something in that entire process, then you have holes in your thinking. Like for example, if you can't get the cash right on, if you can't get your cash figure right, all right, then you have what I call a hole in your thinking. There's something wrong, okay, and that hole needs to be plugged, and it needs, and that means, going back to the very beginning, and because this is supposed to be 100% accurate. Now I know business managers and marketing people, you're kind of like saying, well, don't the accountants create this information? And that's true, right? The accountants are responsible. So if you're in the accounting curriculum, I had a student the other day who, yeah, she was in the accounting curriculum, and it's like, you can't get this right, and you're how far along in your education, realize that this is financial accounting, and this is where you start building. You're in education and you're learning this, and you do make mistakes, but realize that you have to develop the skill sets of being accurate. So you can't just gloss over things. You need to actually work through the work in order to get it correct. So with that said, here's our ratios, and the solution says, I recommend that you invest in mutual material for the following reasons. So we have Anderson versus mutual. Right? It says the return on equity is 4.5% higher. All right, and so that means investing in mutual, you're going to get a greater return on your investment in the business. Right? It also says, let's see, number 2 says, it talks about the return on equity exceeds its return on assets by a wider margin. Okay, the difference between these two numbers, all right, the return on equity versus return on assets, there's a wider margin here. Okay, that means the company is doing more with its borrowed money. Mutual Materials is doing more with its money than Anderson is. Okay, covering its interest, right? It's able to cover its interest a lot better, meaning it has more money to, it's earning more money to be able to pay for that debt that it takes on, right? And it's also turning over its accounts receivable, meaning they're able to collect their cash a lot quicker, right? Now the inventory turnover is less, right? That's a negative for Mutual Materials, and its gross profit percentage is less, right? And its net income as a percentage of sales is less. So this is a good example of what I was talking about at the end of the last video for problem 12-41B. It's not always simple of plus, 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 and minus, 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 right? In this case here, you have a mixture, okay? The return on equity is better, meaning, that's a plus, and versus its return on assets, that's a plus, meaning it's utilizing utilizing its equity and being able to pay off the interest on its debt a lot better. However, and they're able to do that because their accounts receivable turnover is better than Anderson, meaning they're able to collect the cash better than Anderson. All right, but on the downside, it doesn't turn over its inventory as quickly. All right, meaning it's making less sales, and its gross profit percentage is not earning as much gross profit, almost half as much gross profit. I mean, think about it. If I had 100,000 for both companies, and its cost of goods is for Anderson is say 30. That's 70,000 for gross profit. If the gross cost of goods sold for Mutual is 60, that means it's only has 40,000 for gross profit. So now we're looking at what it's doing with its expenses in order to get its profit or loss, right? How is it managing the company in that respect? Its net income as a percentage of sales is almost identical. Okay, so what this means is that Mutual Materials is actually controlling their expenses much better than Anderson Supply, okay? Because their net income as a percentage of sales, how much their income is as a percentage of their net sales, is almost identical, right? Even though Anderson Supply they're buying their product correctly, okay? They're not controlling their expenses correctly, right? And Mutual, even though they're paying more, they are controlling their expenses so that their profit and losses are basically identical, right? And then, sure, Anderson is selling more. They're turning their inventory over at a greater rate, but that doesn't offset the fact that they're not controlling their expenses, right? And then on the with all of those sales, Mutual is actually collecting on their accounts receivable much better than Anderson. So they're able to get more cash flow. That allows them to pay off their debt, okay, which is shown by their interest coverage ratio. They're able to utilize that a little bit, their cash flow from getting the money on the accounts receivable to be able to pay off their debt, therefore having a better interest coverage ratio. And all of this, that additional, because of that paying off the debt, their net income shows that they're able to have a better return on their on their equity, which means a better return on your investment if you're deciding upon which company to invest in, Anderson or Mutual. If I'm looking at this, I'm looking at Mutual and saying, this is a strong reasons for me to invest in Mutual Materials versus Anderson Supply, right? Because they're even though they're they may be purchasing, and just the thought just popped into my head, their cost of goods sold, right, may be higher because they are purchasing better quality material too, okay? All right, that may be a reason why their cost of goods sold is much higher, okay? And if they're buying better quality and they're managing their expenses, these are all strong reasons why this company seems to be being run better than Anderson Supply, all right? So, I started out reading this here memo and I deviated from it because as I started looking at this information, these are the things that were, coming to my mind, okay, as far as how I would be looking at these two companies and deciding upon which one to invest in, all right? So that's sort of like the exercise, and there's, I'm kind of glad because I was like, when I was doing the other exercises and problems, and I would see, all the ratios would be positive and all the ratios would be negative, and it's either improving or deteriorating, and I'm like, this isn't the real world, okay? I'm kind of glad they threw this one in here with these different percentages because this is actually what it's like, being able to piece through the information in order to make a proper decision. So I hope that gave you some insight into it. Now granted, this here is a simplistic example, and like I had said in the previous video, Warren Buffett, this is what he does all day long, every single day, in order to decide what companies to buy, okay? But for you're just starting out, and excuse me, and this gives you, some idea as to what happens. But realize that it all starts, way back at the very beginning with the initial transactions. Okay, Mutual company mutual materials here, they have to buy stuff, okay? And every time they buy something, that's a transaction. And they also make sales, okay? Those are transactions, and those transactions have to be put into transactions. They get put into your journal. Your journal gets posted to the ledger. All right, so make that GL. Into the general ledger accounts, and from the general ledger accounts, we work through the worksheet in order to create the balance sheet and the income statement. Right? Yeah, we took a look at the statement of cash flows and retained earnings. All right, retained earnings is a subset of the balance sheet, just a detail of the equity section of the balance sheet. But by having these transactions and journalizing correctly, this allows us to make sure that we create the correct information. And once we have that information on our balance sheet and our income statement, this allows us to generate the ratios that we need, right, in order to be able to answer the questions that we're looking that we want to perform analysis on. In this chapter, we're shown the 5 key questions, but you're also shown the 5 key questions you can use as a comparison of a company within itself as to whether it's improving or deteriorating. And then you also can look at it as from the perspective of comparing one company versus another company, okay, and whether you want to, which one is doing better than the other for whatever reason, whether, and generally it's investing in that particular business. So with all of that said, if you're not putting any of these here pieces together, okay, then you have holes in your thinking and you need to go back and you need to revisit the theory. Remember, accounting is about, and you've seen this video, you've seen this on every one of these exercises, note, accounting is about understanding the concepts and applying that understanding to the situation at hand. Okay. If you are getting any of what I just explained wrong, that's because you don't understand something. Okay. The application is watching me work it out. But if you don't understand first, then you, someplace way back in the beginning, making journal entries maybe, you make a mistake, and that affects your financial analysis all the way down the road. Okay, so if you're wrong here, you can't make good decisions here. All right, and that's why it's important that you understand everything in totality and not just chapter by chapter. Okay, so if you don't understand something, go back and revisit it, and if you still don't understand something, feel free to telephone and speak with an instructor. And hopefully watching all of these videos gives you and have worked through everything will give you a good solid foundation going forward, because everybody ends up taking managerial accounting next. Okay, so with that said, good luck to everyone and best of luck in your studies.